Global payments, this is just a graphic schematic of what happens when you use your credit card. The most valuable piece of this is the two of the most valuable companies on the planet are Visa and MasterCard, who just collect a toll on billions of transactions and trillions of dollars that happen all the time. And then you look what I've circled up here on the right, the merchant acquirers, global payments, then there's Chase, then there's Worldpay. Global payments is in the process of acquiring Worldpay and will become, when that goes through early next year, it will become the largest merchant acquirer. And this is a business where you can imagine scale matters. And just summarize, the stocks, this was a slide from a week ago. The stock's down about 10% the past week on no news. So it's got a 19 and change $billion market cap, 14 billion of debt, and is trading. It is the cheapest large cap, high quality stock I think I've ever seen. It trades at 6.6 times this year's earnings and 5.9 times next year's estimates. So let me show you why there's such a disconnect. This is revenue and operating income going back 20 years, and you can see it's just been an incredible growth story, but maybe that's not real somehow. So let's look at the cash flow statement. This is a company that the cash flow statement follows the earnings. It generates gobs of free cash flow. What about the stock? Well, it was an incredible growth stock for many, many, many years. And then in 2021, about 4 years ago, almost 5 years ago, the stock has just been on a downward trend, has lost more than 60% over the last nearly 5 years since its peak. The company has continued to do well. That's the disconnect here. So this shows the forward PE multiple of this stock going back since it started trading, since its IPO. More than 20 years ago. And today it is at an all-time low forward PE multiple of 5.9. Historically, it's traded at 18.7 times forward earnings. What are the things causing investors to, in my opinion, just make a massive mistake here? Investors think Global Payments overpaid for Worldpay. They paid 24.25 billion and used stock mostly to do it. And when the stock is depressed, that's dilutive. So investors hated that. They have 14 billion of debt. It's not a dangerous amount of debt given how much free cash flow they produce, but investors hate that. They are worried that e-commerce growth is an area Global Payments isn't as strong. They're worried about competitors like Toast and Clover and Square going after small and medium-sized businesses. They've got a new POS point of sale solution that they need to deploy. They're reorganizing their sales force. They're going to need to integrate Worldpay. All of these things are legitimate concerns. But the company, keep in mind, keeps growing its earnings, its cash flows, its revenues. So these are really more hypothetical concerns at this point. And meanwhile, the stock has crashed as if all of these things had played out and the company's financials were in collapse. So this simply shows that Worldpay and Global Payments, by combining the 3 and 4 players, will become the number 1 player. So I actually think margins, which are already approaching 50% EBITDA margins, have room to the upside. This is already one of the highest margin companies in the whole payments industry sector, likely to go up. Another nice part about this, you have activist investor Elliott Management in here. You have 2 private equity firms, GTCR, Silver Lake, that have significant investments. So you've got smart activist people pushing management. Management is committed to buy back 1/3 of its outstanding stock in the next 2.5 years. So in summary, I think this is a business that should be trading today based on the fundamentals I see at 20 times forward earnings. It's trading at 6 times forward earnings. So I think the stock's a triple in the next couple of years when the market fixes this, realizes that it's gotten way too bearish on an outstanding high quality business.